My name is Nuwan Dishan. I'm from PwC's Academy. And with us, we have two experts, uh, Dennis Cox, who is joining from United Kingdom. He's an expert around financial risk management, and he has over 30 years of experience in this, uh, serving banks, regulators, financial institutions globally. So he was attached to HSBC, Insurance Brokers Limited, as a director, risk management, and he has wealth of knowledge around this area on how financial institutions structuring their risk strategies. So he will have a lot of insights to share, and he also BSc honors degree in mathematics, so he knows the numbers very well. So and with him, the moderator for the session, and to give the local perspective, we have invited Malinda Boyagoda, who is a partner at PwC Sri Lanka, who heads the financial services advisory side. So he is an expert on of IFRS, accounting, internal control, etc., and also audit side of things as well. So he will share the local perspective and some of the challenges that local industry players are facing. So without a further ado, welcome all of you, and I hope that you will get few insights to rethink about how you operate. Over to you, Dennis.
Thanks, Nuwan. So let's get going with the webinar today. So with the introduction Nuwan has given, so agenda for today is basically we're going to have a quick introduction, and then Dennis will take us through managing risks during the COVID-19 crisis as the main topic. Then we'll also look at how it will impact the financial institutions in particular. Then also longer term impacts, beyond the crisis, beyond the next 3 months, 6 months, longer term, what will hold for us will be another concern. And then we're going to have a question and answer session. So what you can do is, while we continue with the webinar, if you have any questions, you have option to raise your questions through the questions and answers mode. So please send your questions through. We will compile them, and at the end, in the Q&A session, we will be answering at least some of the questions that has come through to us. Right. So going on, in terms of an introduction, all of us are well versed and well aware of what is happening right now in Sri Lanka, as well as throughout the world in terms of the COVID-19 crisis. So if you take about Sri Lanka in particular, since we had our first local patient identified early March, then through 2 weeks, mid-March, most of our ports of entries were closed, and then few days later, the country going into sort of a lockdown with a curfew being imposed, and that's what had been the case for the last 2 weeks. So it's a situation of unprecedented nature. We haven't seen this type of a crisis before. So given the extent of the crisis, the responses have been quite alarming as well. Government try to intervene and try to manage the situation, as well as we see regulators, different authorities trying their best to contain the situation. So as part of it, obviously no business, no individual, no company is immune to this or will be out of it. So everyone is having challenges. But in particular, in terms of financial institutions, what we have seen is with central bank introducing a number of concessions to different industries, financial institutions seems to be the one who is front-ending some of those initiatives. Classical example is debt moratoriums given almost across the board to many industries, many companies, individuals. So effectively, nobody will have to pay their loan installments for the next 6 months. So on top of that, they have announced interest caps, interest concessions. Then, more recently, regulators announcing financial reporting relaxations, and central bank looking at how the banks could draw on their capital buffers in creating more liquidity in the market. So, number of initiatives coming through. So, as a financial institution, it's a challenging situation. From one side, you have your own challenges in terms of like any other organization, the challenges coming through the crisis, managing your staff, remote working, cybersecurity, all that is real threats to a financial institution. But in the meantime, stemming from the initiatives the government and central bank is taking, there could be further risks coming on your way as well. If you look at some of the risks, credit risk is real. I mean, there is absolutely no doubt about it. Everybody knows it already. Every company, every individual is some way or the other impacted. So that is going to have an impact on their repayment ability. Yes, the news might come a little later because of the moratorium given, but there will definitely be people who are not willing to repay their debt. So credit risk will be real. So that might not be the only risk that we undergo. Now, liquidity risk seems to be another significant risk. If nobody is going to repay their loans for the next 6 months, while the banks and financial institutions having to still fulfill their obligations with regard to the deposit holders, that liquidity gap is going to create significant problems in the market. And then interest rate risk will be real. Central bank trying to keep the interest rates low, while the financial institutions might have fixed interest commitments in terms of their deposits. Exchange rate, we have seen what happened to the rupee over the last few weeks. Since the pandemic started, we have at least lost 5 to 6% of value against the dollar. Then we have also seen the stock market situation. The few days the stock market operated prior to the lockdown, substantial amount of price reductions we have seen in the stock market as well. So price risk, interest rate risk, liquidity risk, credit risk, all risks are real at this point. So to talk about risks, we have no better person than Dennis, who is the keynote speaker for today. So I know one has already given an introduction to him, but if I were to add a few things, he's a specialist in innovative and strategic finance, risk management, and internal audit. Significant experience in enterprise risk management, where he has worked in a range of global businesses in Europe as well as elsewhere in the world. He's also a fellow and a co-founder and a former chairman of the Risk Forum of UK Chartered Securities and Investments Institute. He's a fellow of the Institute of Chartered Accountants, England and Wales, where he has also been a National Council member for over 15 years. So he's accomplished international conference chairman and a lecturer as well. And he's the author of a number of publications in banking and finance space. So with that introduction, let me warmly welcome Dennis to continue proceedings from here onwards. Dennis, over to you.
Thank you very much, Melinda, and I appreciate that. And hopefully everyone's hearing us nice and clearly from London. And said, when we're looking at COVID-19, it's easy to start to get too depressed and recognize that this is going to be there's going to be some darkness in the presentation. Of course there will. But I want to show you some of the light that hopefully will come through later, and that we will see some positives that come out of all of this. We're going to start to think about what makes a crisis, and so we're going to do the past first. Then we're going to focus a lot on the present and things that people are doing now, and recognize that the peak of the crisis we haven't had yet. So some of the actions I'm going to be talking about, you will be still to future, because as this starts to roll around, and we'll see some of the numbers from previous crises, you'll realize that there's more to come. And then we have to think about the recovery mode and when that might be. And as you said, it's interesting that in Sri Lanka, you're talking about the 6-month loan freeze. There could easily become a 1-year loan freeze, and it's certainly plausible for some businesses that it'll need to do that. But there will also be businesses that shouldn't survive, and what we mustn't do, of course, is waste money on those. So that'll be something that we'll need to think about a little bit as we roll through. And as I said, please do ask the questions. You can ask during the presentation, and we'll spot those as they run, but we'll pick those all up towards the end. So people have talked about some of the crises that we've looked at, and I know you've got the two that I'm going to mention at the end, but the two you want to really look towards, which are the nearest ones to these, are something that are really pandemic type crises. And then we look at this, the Black Death crisis. But in the Black Death, recognize between 75 million and 200 million people passed away. Now that's massive. And it's also over a 4-year period. So as a crisis, it did come in waves, but it never really paused during that period, but it actually killed between 30 and 60% of the population. But what's interesting is population levels didn't come back for almost 200 years. And so this was a long run crisis and had many impacts. Over here, for example, towns closed and never reopened. Now, one of the things that comes out by that kind of number of people missing is that some of the plans just don't work, and they will come back to that. You know, the plans work when people are around. The plans do not work as well when people are missing. And the assumption that everyone that you've planned and trained up for and can do the various roles under a stress environment, that they will be around, that's actually quite a brave assumption under this style of environment. Now, after 1351, it did disappear, and it wasn't that there were new medicines or whatever, it just sort of burnt itself out because essentially the community that had survived had enough coverage so that it didn't recur in the market space. When you then look at Spanish flu, which is perhaps the nearest to now again, look at that global death toll, 17 to 50 million out of 2,000 million. Of course, we've got a much larger population now. 25% of the whole population became infected. Now, the Spanish flu, nothing to do particularly with Spain, didn't come from Spain. Actually, no one actually knows where the Spanish flu came from. Because it hit in 1918, we wanted to blame someone who was essentially neutral, and it was political to call it the Spanish flu. No evidence it came from Spain, albeit Spain was badly hit by the flu at that time because of their problems at that stage. Now, what's interesting is it started in January 1918, and thinking ours really starts this time in January 2020. And it runs then till December, not December 1918, not December 1919, but December 2020. Now, the second wave came in the October to December, March period of 2019 to 2018 to 2019. So you have your first wave, it sort of burns out a bit in June, July, August, kicks off again in the November, October, November period, runs through to the March, and then comes back again the following year. And it was the second phase that was the biggest problem, not the first phase. So most of the deaths came in the phase 2. Now, why was that? One of the arguments people put forward was that the change of diet and the lack of health made people weaker when the second wave came through. There hadn't been any protection come through, and therefore it rolled through the second time. And then by the third time, there were enough people in society who had recovered from the Spanish flu that it actually enabled it to not migrate in the same sort of way. So you had an amount of protection within society. I'd argue that both of these crises are quite interesting because they actually show the peaks and troughs. You see the returning wave with this one. The other one actually had a pretty normal distribution in terms of the impact on society, as opposed to looking at something like the crises that we've had before in the 2008 financial crisis. Now, that did not affect the mainstream markets. It didn't affect retail, the way that people work. The average school teacher wasn't impacted. Factories didn't close. Whereas, so that's quite a narrow crisis, and that's a financial crisis, and that's a liquidity crisis. Now, we could get one of those. That could be a consequence of this crisis, and I'll come back to that right towards the end, because that's actually more looking at how on earth are we going to recover from these difficulties as opposed to where are we now. The crisis we had in Sri Lanka after our event, that's more about optimism and the way people are looking at the market space. And that goes into what we said is it's idiosyncratic risk. So it's really impacts us, but it doesn't impact the rest of our society. Importantly for that one, our customers are not really impacted. The financial institutions globally are not really impacted. So that as a local event is not a great indicator for these kind of crises, because the world will recover from that a lot more quickly than it will from this one. This one is actually going to be quite deep-seated in many ways, and some elements of the market will not recover for perhaps 5 to 10 years. So I know that Melinda mentioned at the beginning about the stock market, and we've had the 4% fall. When the stock market opens, expect it to fall about 40%, and that should be the kind of figure you have in mind for the collapse that would be going through that market space, and do not expect a recovery to pre-crisis levels probably for 5 years. And that's the kind of this kind of crisis. We don't get many of these. There was another one actually in around the 1880s. You've got the South Sea bubble crisis, which also did a similar kind of thing. And so the Spanish flu crisis is another negative. But not everything is negative. And you're going to see a couple of green shoot type positive comments, because everyone's concerned enough. I mean, I'd almost recommend to you to get away from the television screens and stop watching the news for a period. And it's not going to make you feel any happier. You feel grumpy enough already. So anything we can do to cheer ourselves up is going to be quite helpful. Now, as you were saying, every country is coming up with different responses. Now, if we're looking at what we've done in the UK, the payment freeze that you referred to, you've already got in Sri Lanka. That was actually implemented this morning, and that comes press release about 45 minutes ago. So there's a payment freeze on all loans in the United Kingdom given by banks. Now that's quite an interesting comment, because a lot of loans, particularly to small and medium-sized enterprises, are not given by banks in my country, and how they're going to be impacted at this stage, I don't know. Now those firms do not have the same kind of reserves. They aren't banks, so they don't have the capital rules, and it's harder for them to make the same decisions. They've also put a temporary freeze on all credit card debt for up to 3 months. Now, it says up to 3 months, and that's the press release. Literally, I got that just before we came online. But that's dealing with personal credit cards and starting to help people, individuals who are actually in a difficult position, so that they don't go into difficulties. The intention being over here that nobody should come out of this crisis in a worse position than they went into it, such that we can return to normal. Now, of course, the only way we can do that is by putting a lot of government funding in place, which will, of course, severely impact the ability of countries to grow going forward, because of the amount of government debt that we're going to have at the end of this crisis is probably going to be round about double what it was going into this crisis. And it was heavy going into this crisis. So the US had already borrowed 75% of GDP. By the end of this crisis, they should have borrowed about 150 to 175% of GDP. And as you think how that's going to roll through, using the US as the proxy for the world in this case, that comes up with some pretty unpleasant outcomes, and suggesting, for example, that interest rates, as was mentioned, have to stay low for a considerable period of time, maybe 5 to 10 years. They probably will be going close to negative in AAA countries. And there's going to be continual debt relief coming through over the 10-15 year period. And taxation will have to rise somehow. And I need to get growth. Of course, growth can start to repay capital loans. But if I'm going to put money, as America says it is, into repairing all their roads and bridges and all those things that are falling down at the moment, well, that's got to be paid for at some stage, and that is not going to be easy. So we have long-term issues that are going to come out of this crisis. So it'll still be being felt in up to 10 years' time. So don't be that surprised. This thing about paying furloughed workers who cannot work. I mean, if the factory is closed and the employee is at home, they cannot work. It's not an option. And that's 50% to 80% coming up from many countries to pay the salaries. Here, it is 80%, including 80% for the self-employed. And so you can say that people are on furlough, and it means they don't go into the unemployment figures, but 80% of the salary will be paid by government. Now, that's going to burn cash very, very fast. There is a cap on it in the UK of £2,500 per month. Most countries have put caps on. The other thing is that the government are providing discounted loans. So these are loans that will be on the government's balance sheet, essentially. The loan gets given by the bank, but 80% of the credit risk is picked up by the central bank, and only 20% by the bank. And importantly, this doesn't go against the firm's credit rating. Indeed, none of these changes in the UK are allowed to impact their credit rating. So how credit rating agencies are then going to deal with this, that's going to be an interesting challenge. I'm not sure if we have any credit rating agencies listening to this presentation, but they become an issue too. Companies need money fast, particularly small and medium-sized companies. The figure for my country, the UK, has suggested that 25% of small and medium-sized enterprises do not have enough facilities to get them through the 4-week period. And one of the issues is that the help that is coming too slowly. So whilst people have said a lot of things, not much of that has actually turned up at this moment. So that becomes quite interesting. So can we get grants out to them quickly? Can we provide debt relief quickly and be responsive to them? That becomes an issue. The grants here are small, £2,500, £5,000, up to £50,000, whereas the loans are almost unlimited. So, but the loans have to be repaid. And if a firm is actually running short of cash and you give them a loan, then that is actually going to dampen their recovery ability when things start to change. And that in itself could become an issue. Of course, tax payments and payments of what we would say as national insurance can become an issue, but it's going to take billions. And when you're looking at the US bailout that went through last week, the next bailout is already being designed, and it's twice the size of the previous bailout. And guess what? There's going to be a third and probably a fourth and possibly a fifth. A lot of companies don't have any sales. And if you're going to then deal with things like rental and property costs, a lot of those do not decline to zero. Insurance can't decline to zero. Information costs, the cost of renting and equipment and utilization and keeping it running, they don't go to zero. So you're going to have costs coming through. A lot of property companies cannot afford to pass rental. So unless the government's going to bail out property companies, those costs will not decline. And I know that from my own firm. Instead, I'm not working in my main office. I'm in our secondary office. My main office is empty. We've still got all the charges for telco, for our forward contracts, for our equipment, and for the property itself. Plus, actually, we have some taxes which bizarrely haven't gone. So government debt's going to spiral. And the question is, who's going to buy this lovely government debt? And the answer at the moment is governments are buying it. And that could be seen as something that's akin to almost a Ponzi scheme, because it's there's no real new money. Nobody has the money. So there's no new money created to go into governments. It's going to be a lot of the governments are going to be chasing each other. And you're going to see this competition. It could easily lead to, for example, exchange control, as money flows out of some of the weaker countries. And you'd expect a series of exchange controls to go in during this crisis. So that's some of the macro stuff. I'm going to come back to that, as we get towards the back end of the crisis. And I had a call on that, oddly enough, earlier this morning. Recognize I'm saying that the crisis is starting to roll up and ramp up. When we started to think about pandemics many years ago, I can remember one of the banks saying that they were going to model 50% of their staff unavailable for work. And of those 50% that were left, half of those unable to work. Now this goes to, we've all got people working at home. Now we know what home looks like. Home has things that might decide to interrupt our ability to work as efficiently as we might like. They could be called, I think the technical term is children. So the children that are at home can be quite demanding. I mean, I tried to do a training event last week with a group, and one of the people was unable eventually to participate because of a 2-year-old. The other thing is that we have something down in other parts of our house which provide us with food called, I think, the refrigerator. And the refrigerator issue means that you have a thinking, oh, I could do this, this, and this, or I could go to the kitchen and go and get some more food or go and get something to eat. The worst thing actually could be lack of exercise, but all of these things mean that working from home is not working as normal. And then we have to think about what that means. Now, cash flows are changing. We're going to have to think about that, the impacts on the business. And there are very few customers. And will the customers' finance departments that are open be working effectively and efficiently? Are they going to pay as quickly? Governments are saying they should pay faster, but what's that going to mean? What's it going to mean for our customers? And having this customer focused attitude such that you look after your customers think well of you, and that when things return to normal, there's all this positive goodwill that may hopefully turn into some kind of profitability and may be good for the firms. How will that run through? For people in manufacturing, the supply chain's difficult. And we've seen that even with people trying to make ventilators, where some of the components that they need are from companies that have been closed down because they're not seen as critical. And if something like a plug is not seen as critical, then the plug manufacturers can't manufacture the plugs for any equipment, including critical equipment. So supply chain must be quite important. And then, finally, we're going to look at staff and the way that staff are impacted by the crisis. So the first thing is, developing this project plan, thinking through what your project plan is going to be. What you'll have found out is that your business continuity plan that you had probably didn't deal with a whole range of matters that you thought it might do. And quite frankly, no crisis will fit neatly into a standard business continuity plan. Things happen that you don't expect. Now, recognize the first thing is this is a longer duration event than possibly you anticipated. And whilst people are talking about dates like 30th of April, 30th of May, 30th of June, you've got to be realistic that this could run easily into July and then could return again in the autumn. So we may only get a respite of 3 to 4 months during that period, and then it could return again. It depends how much we're going to work. So your plan is now becoming, to an extent, business as usual. And that's a different thought process, because normally BCPs are designed so you can return to business as usual in an alternative universe. But the alternative universe now is this new virtual universe that we're all now participating in. And we have to understand that this will be with us for quite a considerable time. I don't know when planes, for example, are going to be flying. What I do know is that when they do start flying, there'll be nobody on them. Then I have to think about what are the issues I most need to address. So you normally start with customers. What are the customer requirements? What do customers really need me to do? And how can I start to make sure that they are addressed promptly? And so reaching out to them, that leads to my communication strategy and being active and warm and supportive, both of my staff, because they come next, and my customers. So those are otherwise you don't have a business. And particularly as a financial institution, we're just a brand, and being seen to be supporting our brand values will become absolutely crucial to all of this. And that's what's going to make this an event that we will hopefully learn from and will gain more customer loyalty from. This thing about what do I need to manage my people chain. Now, the people chain that you'll have put into your first business, your business. Now, there's not everything going on, and some areas of the market will be of less importance now to other areas of the market. In this country, for example, the courts are closed. So, we can't go to court. So that kind of area of activity will naturally have closed. And that, of course, changes some of our debt recovery work. Debt recovery becomes quite difficult when we're being told by government to be supportive of firms. So the workout team and the special assets team, their jobs change, but you can't assume the key people are there. Typically, when we're looking at the people chain, we're trying to manage this properly to make sure that we've got things so that we can build people around properly. You've got the loop of people, your normal reporting lines, but you have to use the peer group structure to try to bring people up when there's a gap in skills caused by the virus taking out people in various ways. And people can be taken out by illness, but also by the impact on their environment, people around them, and other matters. Data assets are becoming increasingly important. We need to know where our data assets are and how they're going to be properly controlled. As we've got people working remotely, data becomes a crucial issue. It's not going to be as closely controlled as it was within our single central environment. Maybe there are certain things that you're not even comfortable that people would do from their private house. I have to think about encryption. I've got to think about bilateral key exchange and recognize the lack of security that attaches to a lot of the communication mechanisms that we're using. Those of you that have been involved in the forensic side will know how much technology exists to interrupt communication, particularly by mobile phone, but also by even this technology that we're using here. And that, of course, can always be a concern. This idea that this is now becoming business as usual means some of the protocols that you initially put in place, hoping that they were going to be for 2 weeks, 3 weeks, you're now going to have to plan that they could be for 6 months or a year. And the idea then of what I need in terms of the technology at people's houses, reliant upon mobile phones, is not going to be sufficient. We're going to have to get better device quality to a lot of our employees to enable us to run. But understand that if we're going to be dealing with everything in this kind of electronic basis, there are some of our customers who are not so electronic. And then we have to think about how can we service those people. And you're going to have to go back to writing letters, I'm afraid, because at least the post currently is working, and telephoning them and calling them, because they're not going to be picking up the email messages and whatever. So the disaster team, when things are going wrong, are able to override some of our policies and procedures to drive to the way we work for future. And you're going to have to make those decisions quickly. But this communication strategy is going to be very much at the heart of this. As you're looking at what's going to change coming out of all of this, it has a number of matters. All of our customers are impacted this time around, whether they're private individuals or whether they are corporates. It doesn't make an awful lot of difference. Now, people that are employed and paid by government are probably the lowest risk customers, but they tend to be the ones that now I can put into the lowest risk category. They're still receiving their same income stream as before, and they aren't a particular problem. Indeed, some firms are going to do quite well out of this. Not every firm, as we're going to see, does badly. There are winners in this, and the question then is, are those the people later on that need to pay the taxation to assist everyone else? But we're going to look into Treasury and how that impacts. But cash flows clearly are changing, which means all of your fabulous behavioral models that we've been using for Treasury and transfer pricing analysis, that no longer really is suitable and has to be remodeled. And at the moment, that remodeling is probably taking place on a pretty well real-time basis with an approval on a monthly basis by the board to see what it means. Credit risk, all that reliance on those lovely historic models that IFRS 9 really brought in, and lifetime values, and now we're suddenly thinking, crikey, this is a change. This is a major change, and it's a landmark event, which means the future is not going to come from historic data sets. So everything we've done in credit risk has to be rethought through and has to become a lot more predictive, so a lot more quantitative modeling, a lot more economic modeling. Indeed, your economic units should be some of the people who are most impacted by this. Now, we'll look at market and liquidity risk later on, but as you can see, everything changes. The single events covered all matters, and hopefully your stress testing, which is integrated, had a pandemic test in there. Now, it might be a lot more severe because it's a lot more global than you expected, and indeed it's rolled from country to country faster than many people expected. What I'm showing on the left there in that little chart is what happened to stock markets during various periods. You know, forgetting swine flu, where the market actually went up during swine flu and then bounced. But each case, you've got the decline for the others, small rise for swine flu. And then this recovery afterwards. Now, for Ebola, there wasn't a 5% decline, 3.8% movement up on average in markets, or 5% up to 17% for SARS, and 39% for swine flu. But you know, that suggests that if we are going to have the market collapse, the 40% collapse, then we might get some of that back later on. The chances are that we will not get 40% back this time round, but I suspect that when we get the 40% drop over the following 3 months, you can expect a rise of about 20%, 15 to 20%. And the last rises have been little more than dead cat bounces with regret. So in terms of staff, we've got to think about our staff and get the staff loyalty right. Otherwise, they won't be positive speaking to clients. The brand won't get out there well. We have to think of the support that they need and how we supply that to them. What are their needs? And the supportive employer will try to have a team of people whose job it is to try to deal with the difficulties that employees have during this crisis. And that could be from terminal illness type issues right through to short-term financing problems or the difficulties of getting certain things that are needed. Again, the supply chain of people, making sure the people chain is there by dealing the ring and then building people up. Use the reporting lines where you can and work out what it is that people are going to do during the crisis and how that then moves to a business as usual. We're all getting new government rules all the time, and those ones, of course, then have to roll through into systems changes. These have to be tested. They have to be validated. As you're making those systems changes, it makes it easier for the unscrupulous to look into your system. If systems changes are being made remotely, that is even higher risk. You've got to be aware of this and try and have the system changes done in a batch for as short a period as time, such that you're not going to have the unscrupulous coming into your systems. So the level of fraud is likely to go up. So fraud monitoring needs to be really tight at the moment to think that, so that monitoring team is going to be clearly there trying to identify people entering into our systems and what it is that they're doing to try to take matters to matters into their hands, not ours. And this idea of always looking to the plan to return to some level of normality and making sure I can have control on what can be done at someone's house and who can do it. You're going to have a lot more people on a need to know basis than not on a like to have basis. Have a look again at all of those access rights. Limit as many as you can. Some brands are going to be winners out of this. What you've got to make sure is that you're seen as being the supportive brand that people think warmly of coming out of this crisis. You know, this firm helped us when we needed it. And therefore, you're going to this sort of review process, identifying first those high-risk firms that have been particularly badly hit by the crisis. Now, sitting in the Sri Lanka where I've got tourism, and there are no tourists, there's not going to be anyone flying on planes for a considerable period of time. Not all airlines are going to come back to normal, and not all hotel groups are going to survive. So we know that they're high-risk firms. They need help, and they're going to need help not just for the 3-6 month period. They're going to need help during the legacy of this crisis, and that could be up to 2 to 3 years, I'm afraid. And so there's going to be a long-term problem. There's some firms that are impacted by the crisis but are likely to survive fairly okay. And this is probably include some of the retailers, because there could be pent-up demand for retail, for example, so that suddenly you're going to think, well, now's the time to replace those white goods. But there will be a lag because people themselves will have become more averse. Those ones that need limited support, the people actually had to proper cash flow modeling and actually had the 3 months of financial result. Now, I know they come after the first two, and that seems unfair in some ways, so that they're almost being penalized for having been proper businesses. So you take like British Airways, the airline that says it doesn't need help, albeit it said it's going to put 36,000 staff onto furlough today. They've closed their two of their main hubs in London. Those ones come next. And finally, firms that are going to be fine. And some firms are fine. And we're going to see those afterwards. They don't need help. In fact, they're doing brilliantly during the crisis. And just think about anyone that's making equipment that people need, and that they will be lost. So you prioritize those and have a series of action plans coming about that. But I have to then think about suppliers that have been identified on these critical employers. And if these critical employers' suppliers have gone under, they failed, then the supplies are not going to come through. And this thought that in the long term, as we try to get to recovery, supply chains are going to be really impacted, is something I haven't seen people working on to the same extent. I'm sure the individual companies are, but whether the banks are picking that up to the same extent, I'm not sure. So that becomes quite important. This thing of the lack of transport availability, recognizing the amount of goods that used to travel inside commercial aircraft. So in the holds, a lot of goods were traveling. Those flights are no longer taking place. So those goods have got to find a different way to travel. Now, this could include foodstuffs that we're reliant upon. So I think there will be a move, and we're hearing this in the US news in particular, that the US needs to become more self-sufficient in terms of food production and mainstream asset production. Would that be an outcome? Does that mean there'll be less exports and everyone goes more internal at the end of this? Will GDP long-term decline? And we'll have to find out. But there are winners. Clearly, if you're looking at someone like the supermarket chains sales are up about 20%. And they said they've had Christmas every week since the start of this crisis. So the food is gone from the shelves. People no longer worry about the price of items. They're worried if there are items. And that's a big change. And they're taking everything, even things that don't make any sense, are disappearing off the shelves. So they've actually someone that's doing very well. So the food retailer is brilliant, both the local store and the centralized store and the online delivery people. Anyone that's in like the paracetamol and paracodol markets, they're the manufacturers of these healthcare products. They've done brilliantly. Anyone that's doing home delivery services, there's been a big change. And this trend to buying things online has been exacerbated by the crisis. So now my first thoughts are buying online. What can I buy online? I don't really want to go out to the shops, so I'd much rather buy everything and have it delivered and left outside, and then they go and they will stand outside for a few moments. We leave it out for an hour, and then we'll bring it inside afterwards, spraying the box with cleansing products just to make sure. And of course, the products like Zoom has suddenly gone into massive profitability. It was a business that actually wasn't doing brilliantly before the crisis, but they've had all their hopes and nirvana periods come through at once. So there are winners, and some of these firms are going to do really, really well. Unfortunately, they were the ones that were doing well before the crisis and were full of cash. Now, the question is, what is going to happen in terms of taxation on these people, and how will that run? So let's think in a little bit more depth about what it means for the financial institutions. I'm going to look at them from three different angles. Look at it from banking, and then insurance, and finally, the people probably I feel most sorry for, and I'm not sure if there are any of those listening, the fund management, wealth management people. Now, in terms of the banking industry, IFRS 9 is thinking about it couldn't have come in at a worse time, could it really? Because it was hard enough trying to say from historic data sets what our loss provision would be. Notice I'm not talking about the capital calculation here, and they're going to come back to that in a moment. But I'm talking about what provision would we put into our statutory accounts. The logic being that when we give out a loan, we've got an idea what the life cycle loss value would be. Do we now? We used to use historic data, but statutory accounts aren't going to be that useful now, because a set of accounts with a year end 31 December 2019, what are they going to be useful for in terms of predicting the 31/12/2020's figures, or even the 31/12/2021? They might be better at the 31/12/2026, but we've got to get there first, and we're not there yet. So we're not in business as usual. So trying to come up with a loan loss provision, remember that has to be approved by the audit committee, I think that's going to be pretty awkward. And then I've got to factor in that there's a period where we've got all this government intervention, but it can't go on forever. Eventually, if we do that, we'll lose currency. And that's actually quite a worrying thought process, that we could undermine currency itself. And then where would we go? So that can be an issue in itself. So the lifetime loss values are going to be really difficult. We're in uncharted waters, and the historic data will lose reliability. So it's less quality. Now that means all of our credit models, what good are they going to be now? And spreading 5 years of data that we're so used to doing, what's the point? And we've got to try to do economic modeling from what do we know, taking into account factors in markets that we are hard to judge, and then run that through. And that's going to lead to future product pricing and also our future treasury models. So our credit models all need to be rebuilt, let alone revalidated, but thought through again in terms of what we really can do and what the market is going to look like after this crisis. And you need to start to try to build those models now, because you're going to need them. They're going to switch on generally over a period of time, and not everywhere will be at the same point. In terms of the level of crisis, I'd argue that the UK is probably ahead of you in terms of the curve by a few weeks. You'll be having the doubling and the doubling and the doubling again that we'll have. And then the numbers that come out at the back of that, that's what you're going to have to think about, is what I really need. but how good is my data going to be? You can look at some of the countries that have been most impacted. Their data will come out before yours, and then see how that shows. You're looking at some of the quarterly reports of listed firms. The 30 June data set will be very interesting for a lot of these firms. But at the same time, I've got stock markets delaying their reporting obligations, so we might not even see that information set. And so it makes life very difficult. All the models, so your model people need to be worked out, and I have to first work out what are my critical models, which ones do I need to work on. Not sure how many models you've got inside your firm. A typical bank has about 250 mainstream models, maybe 2,000 models in total if they look around everything. Depends how you define a model to start off with, and where we've got a model definition and proper model governance. When you look at the critical models, and they're particularly for me in credit risk, lending areas, pricing areas, and treasury, the market risk areas, then I've got to think, what data do I have and what are my data needs? And you're going to have to look at a lot of stress testing and a lot of the way the modeling goes from one type of firm to another and percolates through the process. You're going to have to create synthetic data, look at what I've got and try to understand what it means, and then trying to run that through to fill these data gaps. And then we have to think whether these attributes will remain solid and valid, or how long they'll be valid for, and will the model have good predictive ability. You know, the alternative always for lending is to go back to experience judgment, but we're in a market where experience judgment has no background. This is new, and so that in itself becomes quite difficult. The attribute weightings are going to be quite difficult. I have to think about my customers, what their impact is. So if I have somebody working in a hotel, what is the chance the hotel is going to open? And then if they do open, will they need the same level of staff? The hotel openings are going to be initially probably 25–30% occupancy running through the first year and a half, increasing after that. Perhaps the good thing is that the event that happened that we were so concerned about in Sri Lanka, that will hide behind this crisis. People will start to forget about that. But you've got to validate the model to see that it's got good predictive ability. I think your models that were being used for decision making will become supporting. Very unlikely that you'll feel confident enough to really take those through. As we're looking across these treasury risks, and I'm showing on the first graph is the collapse of the equities and bond market. You know, so the equity market has crashed. What you've seen in this crisis, money has flown out of the equity market. I've had the bond market go to zero. Of course, it has to be zero. And that's who wants to buy a long-dated 15-year government security that produces you no return? Well, the answer is government and nobody else. So, you know, that's the position we're in at present. There's no returns. And that has a lot of impact, given that we, as the banks, have to have our assets, our capital assets held in liquid assets. If these are the liquid assets and they're getting no return at all, then what's the point of having those deposits if that's where they're going to end up in terms of these asset classes? So that's going to be long term. There's the convergence now of yields to zero to negative right the way across the yield curves. And of course, the yield curve isn't normal. I've got the collapse of the oil price. It was showing 22 at the point of I think it's the March 1 it shows for Brent. It's around 23 at the moment. So it's hovering around this $22 a barrel price range for the world crude figure. Remember, the resistance line was $32 a barrel. That's the one above this one. I think I talked about that when I was in Sri Lanka last time. And the one below this is 14. So we're running in that period. So it could slip down to 14. The figures for the increase in oil in the US went up 6.5 million barrels again. And so we've got this massive overhang of oil sitting in the US, and there's going to be only so many places to put it. So the Treasury guys have got a problem, and this is called the hunt for return. Where do I put my money? Where is the money safe? Which institutions are going to be safest? And the difficulty now, again, with IFRS 9 and fair value P&L accounting, meaning that we're going to take some of these losses on the chin. This is not great news. So the Treasury people will be quite busy. Unfortunately, you've got yields, you've got the bid-offer spreads opening up on the financial instruments and an uncertainty of pricing. And all of that comes through at the same time. So the treasury models, treasury staffing, treasury instruments, treasury counterparties all need work on during this crisis. So the first thing I'm suggesting is work out which of your financial counterparties are most impacted. And if that's the one you're using for a contingency funding plan, well, hey, you can see it doesn't work. But this is one of those crises where a lot of banks are in the same level of difficulty at the same time. So will your BCP work? And which are the banks that are the most impacted? We've seen in Germany them having to take action to support some of their stronger institutions by reducing capital requirements and other obligations, removing some of the GSIFs or SIF rules and LSIF rules, and looking at those capital conservation buffers and allowing firms to build into them. Don't worry, you're not going to be paying dividends as a bank. That's been banned essentially for the UK and Europe, and they can't pay bonuses anymore. So the two things that were the impact of dipping into that capital conservation buffer, two of the three, have been removed from us. But try to look towards where I've got wrong way risk of the assets I'm holding, and trying to hold them as some kind of collateral will start to decline in value at exactly the time I need them to work. And all my behavioral models now, quite frankly, they've got to be reassessed because behavior has gone all over the place and people are just acting differently. When I'm sitting in quite a busy road, no cars are moving, there's nothing happening around here. So your future plan, your 3 to 5 year plan that was given in the ICAP, that now that's a historic document. You can put it on the wall and remember those happy days, and maybe you could unwrap it again in 2025, but not long before that. So quite a lot of treasury risks. Then you've got to identify which of the contractual cash flows still will stick, and some of the things attached to the ISDA. We don't have something from ISDA helping me soften ISDA and ISDA requirements yet. Nothing has turned up from those. Nothing has turned up from SWIFT, softening SWIFT requirements either. So all of those things are still compulsory, and we still have to identify what there is. Then I've got to think about government action on my cash flows and how it impacts us. And then I've got to think about the behavioral analysis that comes out of all the customer impact, not just of government action, but of the fact that people coming out of this crisis will be a lot more conservative than they were before. They're going to be a lot more nervous. They're not going to go back to business as usual. And who knows how many people in total are going to be impacted, but it's a lot and it's global. I'm going to have to look to the financial strength of financial counterparties and look to see the ones that have the strongest financial counterparty strength, look at how they're attached to other institutions, and then try to, where I can, focus towards those and perhaps away from some of the weaker, and only to work with the weaker that I have to do. So if I'm going to have deposits that I'm placing, the overnight cash placement business, then I'll try and place that in places where I'm not going to lose it. In this crisis, people are going long cash. They are not buying anything. They're not buying gold. Gold has gone nowhere during this crisis. It has not gone up in value. They're not buying other commodities. They're not buying equities. They're not buying bonds. They're not buying, and that's got a full stop on the end. So there's a consequence of this. Some of the financial instruments we're using for hedging, they could easily themselves go illiquid. And that means the pricing may become unreliable, or you see that by the bid-offer spread opening out. And so you'll be modeling that and checking on that to see how that works and how that's going to run through the crisis. The insurance industry, I've just got a piece here which I've taken from a quote from 11fs.com. And I've got things like, the Olympic Games being cancelled, all these big events being cancelled, smacking the insurance industry very badly. But this is one of their problems. So they're going to have a lot of claims. They're going to have the health claims, and they're going to have other event claims. And there was already problems in the market, a combination of falling stock markets, increasing mortality. We seem to have both of those. Given that they're looking for a return on the premium, remember the insurance market works from getting a return from the premium, which they're holding in advance, and the lump of cash that they hold, and that's used to reduce the fees. Well, hey, what we're going to see is a series of businesses failing, a series of claims on insurance, and those ones are going to take a lot of capacity out of the market. So as at the end of all this, premiums are going to be higher, there's going to be less capacity, and the payout and travel balancing, they said, we're out of around 275 million people are saying. I think that's about 1.1 billion, but we'll see as it runs through. But business interruption claims, death and medical claims, and there'll be no new business for insurance market, but they'll be closed to, the capacity will be closed at Lloyd's of London. And a lot of this ends up at Lloyd's of London. Now, again, we haven't got a statement from Lloyd's of London as to what they're going to be doing. I haven't seen a bailout for the insurance industry anywhere. So we'll have to see how that runs. Recognize can't do that much running from Sri Lanka, because this is about Bermuda and Lloyd's of London. So some firms are likely to fail. Some insurance companies are not going to make it out of this crisis. The weaker ones will go to the wall. There will be downgrades of some of the insurance firms. I'd expect them all to go on to watch quite quickly. Capacity is going to be held for probably 3 years. There'll be limited capacity, and that does include, I'm afraid, the bankers' blanket bonds, and premiums will need to be higher to recompense. So we're going to have to look generally at all of the policies that they have and all of the requirements we have under our policies, probably be tighter than before. Look at my products going forward, taking some off the market. We're seeing people removing critical illness cover products off the market. Look at the impact on the assets that I'm holding and how that's going to collapse in value, because I've got classic wrong way risk. The assets I'm holding are declining in value, and then change my pricing and all of my marketing materials. And quite frankly, the history is not very good. Now, if the one place you didn't want to be was here, and because the assets under management have fallen, and that's the bulk income stream that we have, and they've fallen 40%. Now, my costs, have they fallen 40%? Well, hey, that's a problem. Now, if I'm then trying to do fixed income and use a fixed income fund and sell people fixed income products, well, in all fairness, the fixed income market doesn't produce a return. So I'm selling you a product where there's a fee and no return. That means negative return, and that's going to be a hard sell for 5 to 10 years if interest rates stay at this kind of levels, which we think they're going to be. So I'm sorry, people that are trying to do fixed income funds, there's going to be movement out of those into cash, probably in the short term, maybe even the medium term, but away from those, maybe into money market funds, but longer dated fixed income funds aren't going to be great. At least the money market fund, the redemption value anchors the price, still no return, but at least that's a bit of a safer place. So if anything, my costs are up. I'm going to have to communicate. I'm going to have to reassess. I'm going to have to do the IT stuff, change my products, look at the way things work. So if anything, my costs are going up, and yet my assets under management have collapsed. And of course, that rolls out into other areas like the pension funds industry. And so people that have pensions and pension funds, particularly those that are defined benefits schemes, they're going to have horrific shortfalls. And again, the accounting rules don't help me now. And for the banks, that comes straight out of my CET1 capital charge. So they're going to have to be, I hope there's going to be some release from some of these requirements to support us during a period. This is not a short-term period of instability, but clearly pension assets are going to decline in value. So what's going to happen on the back of this? So there's going to be a real impact on customers. Every benchmark mandate for a customer needs to be reassessed. The level of assets held in the different classes, that's probably no longer going to be valid. And it's just one of those steps where you're going to have to think about that. I've got to reduce my costs, and the only way I can do that is artificial intelligence. And the difficulty is that means a lot of jobs will not return, processing jobs, reconciliation jobs, but actually also front-end jobs, fund manager jobs. They're going to have to replace by artificial intelligence. There's going to have to be a lot more passive investment. I just can't afford to do what it is. And I think that customers' risk appetites will have changed during the crisis, and we'll need to reassess all of those. And people will be more conservative going forward than they were before. This will have changed your priorities and what you think is really important in life, and that's going to have to flow through. And of course, I'm going to have to restrict fund withdrawals if there's a real problem and I'm running an illiquid fund. And that's going to be things like property funds, maybe some of the commodity funds. We're already seeing that over here now, that some funds have closed already, and fixed income funds possibly. So finally, getting to the long-term impacts. I know I've overrun by a few moments. And one of the things that comes out of this, and we're looking at the the recovered pre-outbreak levels 6 to 7 months. That's typically what you used to see with airlines. The disease outbreak 1 to 3 months, and this comes from IATA, so it's a good source for a look at. They're saying it might recover to pre-outbreak levels in 6 to 7 months from the peak of the outbreak. So if the peak is March, then we might get back by October, but unfortunately, I think we could have another return of the pandemic then, and that would suggest that that might be another year before that comes back. So I'm looking at 18 months to 2 years, particularly for somewhere like Sri Lanka. And from my perspective, as someone that travels quite a lot on business, I've got my passports crying in the other room around the corner saying, "Don't you love me anymore?" Wondering what's going to happen. Well, I'm hopefully that I'll be able to fly in 6 months, but I doubt too much ahead of that. But the new normal after this crisis is not the old normal. And so there were trends going on of artificial intelligence changing purchasing patterns, for example, which will be rolling on through the crisis. And they're just two key ones for me. And we'd felt at a tipping point, and this is going to be exacerbating that trend. So quite a lot of retailers will not come back, and maybe they shouldn't. And what you've got to recognize in terms of help and who are going to assist, if something's a zombie business, it's not going to come back, then is there a lot of point in helping it? So do you have the Google or do you have the Yahoo? Which one have you got? Are you still selling the CDs, or have you moved to the online downloading of music? Are you still going to go to the restaurants, or will you go back to them? Will you continue to buy the online food deliveries? In some countries, the restaurants are closing. So where will that go? So that the new normal is not going to be the old normal. So will people be working at home more? Is that something that's going to come out of this? Will this kind of flexible working, will it continue? Will that change property prices and property demands? And I understand that when something comes through and the growth opportunity comes through, to be able to grasp that and take advantage of that, we'll need quite a lot of cash to take advantage of that coming forward. So to seize, I should say seize, not cease, to be able to seize the growth opportunity. And they will need cash. So that's probably going to be July. And so firms will need cash at that point. But people are not going to be the same coming out of this. So online purchasing, home working, home food delivery, artificial intelligence. I've got to think what that means for us, what that means for our employees, what that means for our customers, how that's going to roll through, and indeed our customers, we're an FI. And how does that roll through this crisis? And what is life going to look like afterwards? It will not look the same. And if you're hoping it's going to just return and that everyone believes this won't be happening. So for us in Sri Lanka, what does this mean? There are going to be less airlines flying going forward. There are going to be less planes going forward. The orders for the new planes are all going to be cancelled. So it's not great for Boeing, who had difficulties before all of this, or Airbus. Vacation activity 2020, quite frankly, there won't be a vacation season now. People who are the customers who would have come to Sri Lanka, they're just not going to come this time round. Their priorities will have changed, and vacation, that's the first thing you can cut. So they're not going to be there during 2020. But it is very unlikely that we're going to have a great season in 2021 either, because the overhang will run through and people are not going to enter it into the same position. The UK government are trying to get people at the end of this crisis the same position that they were when they went into it, but they will not be the same risk appetite, and they'll be very cautious for a period. This thing about the cargo finding new routes, will it go back onto airlines? Does that mean that shipping for the first time for a period is going to be quite a profitable industry? Who knows? At least the oil prices being subdued is good for Sri Lanka, and I can't see any reason for that to change. Everything I see is a negative for oil at present. We're down at 24, and I think it's going to be running around this 30, 20 sort of period for a while now. But the trade deficit's going to widen, the rupee will depreciate. Government's going to continue to want to curb import demand. Maybe we're going to make more things locally. Maybe there'll be more entrepreneurial effort coming up, but there's going to be slack consumer demand going forward. And so that the outputs are quite poor coming out of all of this. So as you're looking, there are winners. There are people who are going to be successful, but this is a game changer, and the impacts are many. and all over the place. And this is going to be quite hard for any risk function to get hold of, as it is indeed for any board. And I would have thought the boards themselves will be looking at where their advice is coming from, how they're getting information, whether we're getting that economic insight to enable us to really picture what's going on. And obviously, a presentation like this, I can only give a flavour of some of the things that concern me. They are many, and this is all part of the challenge that we're going to have, particularly in doing the next ICAP, as we're sending information out to the central bank about what we think is going on. But don't worry, they've got the same issues too, and so have government. So that's the presentation as far as I was going to run it, Melinda. So if I pass it across to you now, and perhaps you could run through the questions and answers. Hopefully some people have asked some thoughts and things that they're like. I can see the thing about will the size be given to us, and perhaps you can deal with that one first.
Yeah, thanks, Dennis. Thanks for all the insights and the knowledge that you have passed on in relation to what we can expect in the coming months and weeks. So one question that we have here is an interesting question. When we left offices before the lockdown and before the crisis, all the companies, individuals had business plans, budgets, targets, all that. So the question is, just let me, how relevant will be the pre-crisis business plans, budgets, targets companies had will be at this point and going forward?
Well,
what will be your response to that?
Yeah, some of them will be useful, but not for about 4 years' time. So 2025, they could be quite useful. I'd dig them out then. So the question is, when will the new normal look like the old normal? And it's quite a long way out. Now, we have this period when, quite frankly, you don't have a business plan. So nobody has a business plan for this. You had a contingency plan, but you didn't have a full business plan, and not for an event of this length. You're going to start from scratch again now, and then think about what it means all the way through. So you will not start from the previous budget and forecasting. You need to start through from what you're trying to achieve, what you then need as resources to achieve that. You'll have some data, which then starts to come up to the new series of assumptions, but all the things you've got on costs related to volume, they've gone. None of that's going to be valid anymore. All the things you have about the way that the market operates and behavioral data sets, they've all gone. So we have a different set of behaviors. So that's why I was saying you're going to have to go back and look at all these models, because a lot of the budgets and forecasts, they're models, and work out the ones that are the critical ones, and then try to improve them as best you can. And as a firm here, I run 4 series of forecasts at the moment, and I've got the expected short-term one that I update every day, and it's a long-term forecast, 5-year forecast, but I'm updating that daily. And then I've got one that I expect with medium recovery, one I expect with 0 recovery, one I expect with a normal recovery. And I'm actually running 4 sets of plans. So I'm spending all of my time trying to reforecast. And my business is not that complex. Yours is a lot more complex. And so, that kind of thing, that's the thought process you're doing. And you have to be willing to throw away an awful lot of the stuff that you've been using for years and say, hey, that was last year's world. We're now in this year's world, and unfortunately it's different.
Yeah, and then another question that we have, Dennis, is around the IFRS 9 impairment modeling. Again, something that a lot of people have been asking questions about. So, the old models that we have, the IFRS 9 impairment models that we have, do have a forward-looking component to it. So the question is whether that forward-looking component that we already have in our models be robust enough to take into account an incident like this, which means, can we do some recalibration and still use the existing models, IFRS 9? Or if not, does this mean that we need to rebuild our existing IFRS 9 models?
Well, the answer is yes and no, as always with all these things. One of the things that comes out for me very clearly is that when you did the work and you were identifying what were the things that meaningfully designated the risks, separating one risk from another, the meaningful differentiation, that analysis, a lot of that analysis you want to revisit, but it should remain valid. So that part is okay. Now, the question then is to what extent under this crisis I need to rebalance the attributes inside the model to come up with more predictive information sets. That's where you've got your challenge. So it isn't actually the pools. The pools should be okay. The pool analysis, that should be okay. It isn't actually the primary attribute analysis of identifying the key attributes, although it's worth revisiting. It's actually the weighting and analysis that comes out of that. That's the part that's going to have to be rebuilt, because clearly now the data inputs are not going to be representative of the population on which we're going to use them. So the world has changed for us, and we need to understand what that means. Now, there will be some pools which won't have changed much. And so, for example, your retail pool for government employees, I identified that one earlier, that's one that I don't think will have changed, and I don't think you'll need to do that. So when I did that priority chart, and some people are saying, I went through the slides promptly, and when we see the slides, the answer is, of course, yes, but PwC will explain how you're going to get them and what's going to happen afterwards. Those ones are okay, but the prioritization of the four highlights that the first group are the ones that you'll need to focus most on the pools of assets, and then the second group, third group, fourth group, and you'll run through that kind of periodicity to actually make sure you spend time where it is most valued. So things like transport. If you're looking at a warehousing, they are actually going through a brilliant time at the moment. So in fact, their future is better than their past. Whereas a lot of other businesses are the other way around. So we're going to have to think about the pools that matter and the ones that don't. Whereas a school teacher or a policeman or someone like that, they've still got the same salary as before. They're not really impacted.
Right. And yes, I mean, also in terms of accounting, looking at accounting, because still it's quite unknown in terms of how this thing will play into accounting. A lot of unknowns in the interpretation of accounting, especially with regard to IFRS 9 so far. So what I can say from my end is there is a lot of discussion happening around how IFRS 9 will play into this crisis and how to take alternative actions with regard to IFRS 9. And those discussions are currently happening at CS Sri Lanka level. So the Accounting Standard Interpretation and Implementation Committee is looking into these in number of fronts. So there should be communication coming through CS Sri Lanka about the accounting impact of COVID-19 pretty soon. So that should guide a lot of companies and individuals in terms of how the accounting should happen going forward. Because otherwise, this is a situation where a lot of people can start interpreting things differently. So I would encourage our accountants and financial professionals to just hold on for a couple of days, and once the common publication comes from CS Sri Lanka, that should be a starting point for a lot of accountants to rethink how IFRS 9 and the other accounting standards will have to be considered in the current context in terms of financial reporting. We do have a few more questions coming through. So let's just publish one more question. What are your thoughts about the recovery of Chinese economy will have as an impact on some of the Sri Lankan industries? Your thoughts, Dennis, on this?
Well, the Chinese economy was struggling before the crisis, and how fast it was slowing down and what the impact of that was very unclear. I mean, China is an enormous country, and we look about it and try to suggest like it's just a small country. It's not. It's an enormous country. Things do not happen evenly over that country. Now, what's going to happen on the back of this? One of the things about the recovery there is, one of the consequences is their goods will not be traveling as much out of country. Exports to China are going to be in difficulty. Now, they need money coming into China, and they need to carry on exporting. The US is clearly going to try to become more self-sufficient. I think a lot of countries will. That suggests that the recovery of the Chinese economy will not probably happen, and that they're going to have to reposition, because they were trying to aim for the volume production part of the market space. If that starts to become replaced by local production as a consequence of government intervention part of this crisis, that is going to have a long-term drag on China. And now, will it have an impact on Sri Lanka? And probably you're better at answering that than me, but one of the things is that means that they're going to be under real price pressure. And that could be a positive longer term if we can get the goods in. But obviously, you're more local than I am. So what do you think?
Yeah, I think the same here, Dennis. I mean, Chinese economy, the recovery is, the only good thing is at least the first wave, China has really managed to curb the infections in the first wave. So we hear news about them restarting industries, and also one other thing to remember is China did not go for a total country lockdown. Only part of China went into a lockdown. So we have a lot of Sri Lankan companies relying on China in terms of as part of the supply chain. So that fear might get lessened as China moves back into production and all that. But the bigger challenge would be with that supplies coming in, what will happen to our demand? So we hear, particularly from the apparel sector, for example, a lot of future orders getting cancelled, and then even if the supply flows continue, whether from demand side, whether we will have enough jobs to work with the supplies that are coming through will be the real challenge going forward.
Yeah, you have a trouble with that part of the supply chain gets disabled. And so one of the concerns we have with China is saying that they're returning parts to, I wouldn't say it's normal, they're just beginning to start with things. But because they didn't do a total lockdown, we're expecting a second wave. And it's certainly plausible that in 2 months' time, China will be pushing back the lockdown again, because they didn't do a full lockdown, and therefore these people are starting to travel. And if you allow these people to travel, I'm going to have people wandering around who either have the virus and don't know it, or have had the virus, going into areas that didn't have the virus. And now what's going to happen? And the answer is we don't know. So I am very nervous of saying that China is recovering. And I'm using the Hong Kong example, because obviously Hong Kong looked like they had control, and now they lost control again. And then it started to spiral up, and they had to tighten back up again. That is certainly plausible in China, that we will go through, unfortunately, a second wave, which will be running through April to May. So I would think that probably at the end of April, they're still going to be quite tight. Recovery, there'll be some recovery June, July time. It'll be patchy. And then I've got to think, if I'm going to bring the stuff into Sri Lanka, do I have the customers? Will my customers want the demand? I've got to ship it in. I've got to ship it out. How's it going to shift? Will those transport links still be there? Because they're not going to be the same number of passenger planes. That's not going to come back this year. So the passenger plane volumes, they're going to be depressed for quite a period of time.
Right. So I guess we are going to conclude proceedings with that, given the end of time here. So as a concluding remark, what I can say is you should always also remember that past history shows strong organizations do tend to weather the storm, and then also they tend to gain market share post-crisis. So it's a lot about how companies manage these risks in the current difficult situation. And if you and the companies who are strong and manage to overcome this crisis through good risk management will end up doing quite well post-crisis as well. So with that, thanks so much for your insights and your sharing of knowledge, Dennis. So with that, we conclude our webinar today. Stay safe.